as I say, there's no certainty. None of us has a crystal ball. We can't see what the future holds. But I'm hoping that this, which is a series of, third in a series of 3 webinars that I've been running about the coronavirus epidemic and how it's affecting the economy, hopefully this will help you as an investor to move forward. So tonight's webinar is third in a series of 3. And if you haven't seen the other 2, please do feel free to go on my YouTube channel where you can download and watch the other 2. And tonight we're focusing particularly on the money markets and in particular the USA and how our relationship with the USA has quite a big impact on our economy. We're also going to be thinking about the banking sector and their response to COVID-19 and what that means for us as investors. And finally, of course, we bring it right down to practicalities. How does this relate to HMOs? What does this mean for you if you have an HMO? So I'm not here to give you mortgage advice. I'm not going to give you financial advice that's on a personal level. This is just education. I am very, very lucky, though, that at the end of the session we have this evening, one of my key financial advisors, a guy called Bruce Mannering, who's actually in Australia, has very, very kindly put in some extra information about his perception on what's happening as a mortgage advisor. So please do stay on to the end because I think you'll find his input really, really helpful and useful if you are looking to refinance or get a new mortgage, or you have a mortgage application that's going through at the moment. So this is my YouTube channel. And if you haven't already seen the videos in the series, the webinars in the series, please do feel free to go there, and you'll see them listed in the channel listing there. So I want to start tonight by looking at the wider markets. Now, what do we mean when we talk about the markets? Well, of course, way back yonder, thousands of years ago, people used to trade by swapping goods. So here we have somebody in a market in Far East somewhere or the Middle East somewhere, and the guy on the right's got a basket of fruit and veg, but he's got a lot of fruit and veg, so he decides that he's gonna meet his friend Elia at the market, and Elia has got a goat, but she's decided that she really doesn't need this goat anymore. So in fact she speaks to Joshua and says, Joshua, I'll swap you my goat for your basket of fruit and veg, and a trade is undertaken. And this is effectively a market because they are trading, and all markets rely on the exchange of goods or services or assets to happen. Now, following on from trading, of course, money was created. So a few thousand years ago, we realized that actually trading in goats or fruit and vegetable was not really very handy. It wasn't very usable. So we created coins. And coins had an intrinsic value, so we used gold and silver because these were high valued metals, and we would trade with gold and silver. And this was money, so this had real value. It was not a representation of anything, it simply had value, but it allowed, if I was in the market and I wanted to buy a goat, I could give you 3 silver coins for your goat, and if you wanted to buy some fruit and veg from me, you might give me 1 silver coin for my fruit and veg. And this way we traded, we used money to trade with. Now money is what we might call the real value of the transaction. So money is the actual transactional value that takes place when those two, when that agreement, if you like, is reached between the person who's buying and the person who's selling. But this is different from currency. So the pound, the dollar, the yen, the rand, these are all currencies. These are all, if you might want to call them paper money. They're not real money. They just represent money. And for many, many years, we had something called the gold standard, which I'm going to talk to you a little bit about tonight. And money was gold, but we had paper money. We had currency, which represented the gold that was in the coffers of the banks. But nowadays, we don't have money based on gold. It's called fiat currency. Now, I know you may already know this, so apologies if I'm teaching many of you to suck eggs. You're thinking, yeah, we get this, Wendy, already. But maybe for some people, this may be a bit new. So I'm doing some basics before we build on the basics. And Fiat currency, which is a trust agreement, really, in terms of trade. You're trusting somebody that there is an inherent value in that paper money, in that paper currency. The problem with it is it can be printed. And recently, of course, we've seen a lot of printing going on, haven't we? We've seen the government producing a lot more money. Well, actually, it's the banks that have produced the money, but the government have issued gilts to be able to sell to the Bank of England, and the Bank of England have produced the money to be able to buy them. The problem with fiat currency, though, is, and this is true if you look through history, all fiat currencies fail. So one of the areas that we've got to be aware of as property investors is that currency, which is not isn't backed by anything, which is just a representation, can be printed. It can be printed up time and time and time and time again until we have oodles and oodles of it. And of course, this is what has happened in Venezuela, and it's what happened in pre-war Germany when they printed and printed and printed the notes, which didn't have actually any intrinsic value. The fiat currencies eventually fail. So just bear that in mind as we talk about some of these markets. So here we have a sample of some markets that happen. We've got the stock market. We've got the housing market, which is what I mean by, I suppose, buying and selling housing. We've got goods and services, which we trade. We have international markets. We have commodities, which is things like wheat and pork bellies and goods which are grown, if you like. They are sort of natural resources that we might use. We have oil, that's a separate market. And of course, recently you've seen the price of oil go absolutely plummeting down to the bottom. You've got the rental housing market, and you might be already part of that housing market. You're part of the rental housing market and you're part of the purchase housing market. So these different markets sell, or what we might say trade, different things. Again, on the very same basis, those two people in that market in Jerusalem first traded their goat for their basket of fruit and vegetables. Now, one thing, of course, we must notice about different markets is that they are affected by their locality. So I've put two arrows on this map here of the UK, and I'd like you to tell me, the first arrow at the top, which is pointing to Aberdeen, what is it that Aberdeen, what would maybe the local market in Aberdeen specialise in? So what is it that Aberdeen might be famous for in terms of what it trades? Andy's got it in one. Very fast. Fast fingers on that keyboard, Andy. Yes, it's oil, isn't it? The Aberdeen industry is very much based on oil, and we've seen a lot of house price increases over the last few years. Actually, not so much recently because they had a depletion in funds from oil, but certainly between about 1995 and about 2015. Some very, very good years for the local economy in Aberdeen. Okay, second question. What about Liverpool? So the second arrow is pointing at Liverpool. What do you think Liverpool trades in, or historically, how has Liverpool made money? Again, answers in the chat panel. Great one, Sarah. Certainly slavery, up until about 250 years ago, because of the docks. So slaves would come in and be traded. Absolutely. The docks, says Dave. Yes, and Neil. International trade from Andy. Absolutely. And perhaps more recently, what other things do we know Liverpool for? Perhaps in the more recent past. Pubs, yes, definitely. Oh, I love you do, I do. European City of Culture, yeah, that's that too. That's that, yeah. all you need is love in a city like Liverpool, don't you? Just all you need is love and a good accent, which is what I haven't got this evening. The Beatles, tourism, yeah, all of that as well. That's absolutely true. That Liverpool has got lots of different industries, and tourism is a key one. So we can see that even within a country as diverse as, and actually as small as the UK, we've got different markets. We've got different markets that we are trading in. And it might be that there's somebody from Aberdeen, who's made their money in oil and decides to go for a weekend in Liverpool and spend some of that money. So they're trading their oil gains down for tourism gains down in Liverpool. So if we kind of draw that out now to thinking about the world, and we think about the global economy, this is true of the UK and of America. We have very close links with America for a number of different reasons. Neil says football as well. Absolutely, Neil, that's true too for football. There's two important clubs up in Liverpool. So the UK and the US have got a very close trading link, again, because we do a lot of swap between those two countries. So what is it that links us to the United States? Well, we export more of our goods to the US than any other country in the world. So this makes them our prime customers. So we need them to buy our goods because more things get shipped from the UK to the United States than get shipped from the UK to any other country, even the EU. We buy more stuff from the EU than we buy from the United States, but we sell more stuff to the United States than any other country. So they are our number one export market. So that's very important. Major banks have presence in both countries. We do lots of stocks and shares trading as well. We've got lots of intermingled companies, industries, organisations. Companies that maybe started in the UK now moved over to the US and vice versa. So there's lots of links between the two countries because of business. Tourism, of course, links us as well. You know, the Yanks absolutely love coming to England, don't they? And hearing our English accents and going to Windsor Castle and Buckingham Palace and so on. So there's a historical and a kind of tourist link there. And travel, business. But the biggest factor tonight that I want to highlight to you is the fact that the dollar is the reserve currency. Now, all these other things are important and they have an impact on our relationship with the United States. But the dollar being the reserve currency is probably the most fundamental reason why we should all keep an eye on what happens to the dollar over the next few months and years potentially, because the dollar has the possibility of destabilizing everything if it goes down. Now, that's not necessarily a bad thing. I'm not trying to put the fear of God into you, but this is the situation. So what does it mean to be the world reserve currency? Okay, so let's just go back a bit in history. I can kind of give you some context. So the first dollar was printed in 1914, which was when the Federal Reserve Bank was created in the United States. The Federal Reserve Bank is a bit like our Bank of England. It's like the American version of the Bank of England. And the reason that it was set up was because bankers had set up in all sorts of different states, and they were issuing paper dollar notes. And the problem was that there was no way of unifying those paper dollars across the United States. So one state would say their paper dollar was worth 4 ounces of gold, and another state would say, well, ours is worth 10 ounces of gold. And they needed some way of unifying the currency. So the Federal Reserve Bank was set up to unify the paper dollar system. And it took charge then of printing the paper dollars, which were then distributed across the whole of the United States. Fast forward to World War II, and as we know, we were dependent upon the United States as our key ally to win the war. Now, what that meant was we bought an awful lot of goods and services from the United States. And in order to fund that, we gave the United States gold because we didn't have enough paper money to be able to, currency, if you like, to pay the US. So we had to pay them in gold. So we actually gave the United States a lot of our gold. And they are they're the biggest holder of gold currently, not just because of the Second World War. They were already a very big holder of gold. But we gave them extra gold in the Second World War. Now, because of the Second World War, because of what had happened and how this had impacted a lot of countries' economies, we were all very, very poor after the Second World War because of the cost of it. There was a meeting called the Bretton Woods Agreement, and the Bretton Woods Agreement agreed that because the US had the biggest store of gold, we would link our currency, our Great British Pound, to the dollar, and the dollar would be linked to gold. So what that meant was that for every ounce of gold, you could print about $20. And it meant that we, under the UK, we would print a certain amount of pounds linked to the number of dollars. Now, this, of course, gave a lot of stability because it meant that there was a kind of agreement that while the dollar might go up and down a little bit in value, and they might print a little bit more here and a little bit less there, basically the fluctuations were supposed to be fairly even. And this would mean that the world would be able to trade fairly and squarely because we all would have the same kind of amount of currency. Now, in 1971, something momentous happened. Now, quick question for you. What incident caused the gold standard to end in the United States? Does anybody know what it was when Nixon took the US off the gold standard, which is what happened, and that basically he delinked the dollar from gold? What was it that caused that to happen? Does anybody know? Good answer, Dave. Oil crisis. It wasn't an oil crisis, but a good try. By the way, if you want everybody else to see your answers, if you just pull down the little box that says all panelists and attendees, and everybody else can see that, can see their answers. Watergate, that's great. Sue. 10 out of 10. Well, actually not 10 out of 10, 6 out of 10 because you got the answer wrong. Yes, you've got it, Dave. The Vietnam War. That's absolutely it. So, Andy, that's a really good stab at an answer. Again, that wasn't the answer, but a really, really good try. Yeah, brilliant. Okay, fantastic. It was, okay, Sue, 10 out of 10. Gold star from the head teacher. It was the Vietnam War, absolutely. The Vietnam War was so incredibly expensive for the United States that they had to print more currency to be able to afford to pay their debts. And Nixon looked at the link between the amount of gold they had in their reserves in Fort Knox, and he said, you know what, we haven't got enough gold to be able to print the money because there was always a relationship between the amount of money they had and the amount of gold. We didn't have enough gold, so he said, right, we're going to have to temporarily, this is the word he used, we're going to temporarily de-link the dollar from gold. Well, that was 50 years ago, and it hasn't stopped. So it was hardly temporary. But so the dollar was de-linked from gold, but the dollar still remained as the reserve currency. So what this means is that across the world, and you can see from the statistics there, that more than 61% of all foreign bank reserves are denominated in the dollar, and nearly 40% of the world's debt is in dollars. We depend on the dollar. And while we might talk about the pound, and the pound is obviously an important currency for us, and that's what we trade in, actually we need to be looking to our friends and compatriots over in the United States to really look and see where the future might lie for the UK economy. So the gold standard, as I explained earlier, this is a good indicator of what was going on with the gold standard. Money was backed by gold, and it's a system in which the currency is backed by gold reserves. So it's very, very straightforward mathematically. Now, the benefits were that it gave long-term price stability. You didn't see a lot of fluctuations. But it did also mean that lending and borrowing and debt were hard to create. You couldn't create as much debt as we have currently created, because the volume of gold that was stored would limit the amount of money that could be printed. Now, this has a disadvantage, because if you can print money, it means that in times of difficulty, such as we're having at the moment, you can produce more money, which can help to grow the economy. You can inflate some aspects of the economy. So if you want to grow certain things in terms of maybe you want to invest in something, you can put money into certain investments like road and railway building, which can create jobs, and it can, you know, improve the economy. However, it can also create this boom and bust cycle, because instead of having stability over how much money is printed, we constantly have instability about how much money is being printed. And this creates a boom and bust cycle. Now, this chart shows to you the value, the drop in value of $1,000 in a gold ounce. So in gold ounces, sorry, since the Bretton Woods Agreement, which is about 1955. So on the left-hand side, we've got there that an ounce of gold was worth $35, and the value of the dollar has dropped. It picked up a little bit in the 80s and 90s and dropped down again. And between 2005 and 2015, of course, we had the banking crash, the banking crisis of 2007, 2008, and lots more US dollars were printed. And so the value of the dollar went right down again. And that's what you see there being talked about, the stagnation and depreciation. So effectively the gold went up in value because the dollar came down in value. And if you ever go on any gold charts, you'll see how the price of gold has increased year on year. And you could even take this chart and compare it to a gold chart, and you'd see the inverse relationship between the two. So it just reveals just actually how much, particularly if you look at the 1970s, what happened then, how much the dollar has reduced in value. Now, because the dollar has reduced in value, of course, what do you think has happened to the pound? So as the dollar has reduced in value, just stick in the chat panel, if the dollar has reduced in value, what has happened to the pound? Do you think the pound has gone up in value, or do you think the pound has gone down in value? Just put up or down. I'm getting you to really think hard here, aren't I? GCSE maths test at the end. So remember, we are linked to the dollar. So the dollar, if the dollar, you know, is the reserve currency, if the dollar goes down in value, then the pound goes down in value as well. So down, down. You're absolutely right, Sarah. Dave said it reduced. Sue said it reduced. It reduced in value, absolutely. So the pound came down in value just as the dollar came down in value. And for those of you who are of a certain age, which I count myself one, if you remember the 70s and a period of mass inflation, the government printed lots and lots of pounds because things were going off a bit of a cliff with the economy. And there were lots of riots, and I remember in the evening sometimes my parents having to light candles because there wasn't enough power from power stations, electricity outputs, and there was the problems with later in the 70s the miners, and you know there was lots of unrest. And this was a period of mass inflation because suddenly lots and lots of pounds had been printed, they'd come into circulation, but consequently everything was getting very expensive. And of course this meant that the pound was going down in value. So we can think a bit like we were on the Titanic. Imagine you are somebody who is on the Titanic with the Americans. Benjamin Guggenheim was somebody who was on the Titanic, and he said, "We're dressed in our best and are prepared to go down like gentlemen." Astor, Colonel John Jacob Astor, was also another one on the Titanic. he was the wealthiest passenger on board with an estimated fortune of $87 million, but it didn't save him when the Titanic went down. So we are on a bit of a stormy sea at the moment in terms of the world economy and because of coronavirus. But actually, the economy has not been in a good shape even before coronavirus, despite what some people might say. Absolutely wasn't in a good shape. And in fact, this could be seen as a bit of a Titanic moment. And it doesn't really matter whether you are British or American. If you are on the Titanic, you probably will sink and drown. So tonight, I want to help you if you're thinking, yikes, this is a bit scary. How do we get out of it? And how do HMOs fit into this bigger picture? And I'm going to tell you exactly how in a few moments. So you might be thinking, but Wendy, this is all very well. That's all history. It doesn't count today because we're not on a gold standard anymore, so it doesn't matter. Okay, and that's a good challenge. But of course, because we're not on a gold standard anymore, this can lead to instability. It can, of course, cause some more stability because if both countries agree to print money at the same rate, then we have stability because it's like a seesaw where both countries have the same amount of money. But what we're seeing at the moment in response to the coronavirus pandemic is countries printing money without really much relationship to each other. Now, the other thing that can happen, of course, is because we're not on a gold standard, governments can issue gilts. So this is what's happened with our UK government, is they've produced bonds or gilts, which is government bonds, and they've sold them to the Bank of England. And the Bank of England said, yep, we'll buy those and we'll create some more money on our balance sheet and we'll buy those. And then all that money can then filter into the economy. Now, this means that governments owe the Bank of England that money effectively, and they can create huge debt. So our economy at the moment has got, I think, about £2.1 trillion worth of debt. And that is about £500 billion more debt than it had about 3 months ago. So it's an absolutely huge amount of money. It's about a quarter of the UK GDP. So we have to realise that our trading is still based on the currency. It's not money, it's based on currency, it's based on faith and trust and belief. We have to trust that the US government and the US economy is still working. And we might look at the stock market and think, yeah, everything's okay. And we might look at, trade is still going on, so that looks good. Oil has come down in price, so that's probably a good thing because it means prices might go down rather than go up. So it means, yes, we've got cash flow. Perfect. Boom. Thumbs up. But we've also got a massive overhang of debt. And what does this lead to? This leads to a bubble. And this is how boom and bust happens, because a bubble is created. Okay, I'm going to pause for a few seconds there because there's a lot to take in tonight. So can you write in the chat panel, yes, I'm with you, Wendy, or no, I'm lost. Yes, I'm with you, or no, I'm lost. So I know if you are okay. Sue's with me, Brill. Dave's with me. Yes, Sarah's with me. Pete's with me. Dave's still hanging on. Or is that Sue still hanging on? Maybe Sue's still hanging on to Dave. Who knows? Andy, you're with me. Good. I think everybody else is falling asleep. Never mind. You can all watch the recording of this another time if you lose bits of it. So this is another quite interesting chart. Beatrice, fantastic. Great to have you. Thank you for messaging me. That's great. Okay, great. So this is a chart that shows the breadth of price to earnings ratio. So this is to do with house prices. So let's kind of get this back down to where we're interested, which is all about house prices and earnings. So this is where you see the difference between house prices to earnings at a given time. So the red line indicates where the PE ratio, price to earnings, is high. In other words, let's say you've got somebody who's earning £30,000, and in order to buy a property, they have to borrow 7 times their income. So they have to borrow £210,000 to get on the property ladder. If you were on the green line, somebody would only have to borrow 3 times their earnings, so £90,000 to get on the property ladder. So this chart really shows the relationship between those price to earnings ratios. Now, the key line to look at is the black line, because the black line shows over the years where the PE ratio has been. Anything above in the red zone, you might say, the sort of red amber zone, is a bubble, because this means that people are borrowing much more money than they really can probably afford. And it means that house prices are higher than they probably really should be. Now, if it's in a green zone, that's usually a depression, because it means house prices are much cheaper. It's probably a buyer's market. And it means that if you're only £30,000, you could buy a nice house for £90,000. That's quite a good bargain. So it's probably a depression. So this is a quite interesting chart that shows us that pattern, if you like, that kind of curve of the market. And if you look right at the end here, so this goes up to 2017, you can see that the black line was almost off the end of the rainbow, which means that this is a potential bubble. This is a sign of a housing bubble. And it means that we are right at the top end of what people are able to afford in terms of buying a property. Now, this chart is from the Nationwide, and this shows a similar kind of trend, that the average UK house price has gone up significantly over the last 10 years. Again, it's something that we might say was a bubble. It's a growth pattern that is probably unsustainable, because salaries have not gone up that much. I mean, look at it. In April 2010, you could buy a house for 170,000. In April 2020, this month, this has literally come out these last few days, it's another £50,000 more. Now, most people's salaries haven't gone up by £50,000 more per annum in the last 10 years, since 2010, have they? If they had, wow, that would be great, but they haven't. So we can see that there's the correlation between the price of property and incomes is creating a bubble, or it has created a bubble. Now, this is a chart from the United States, and what we see here is if you like, a similar trend to what we've seen on the previous chart, to the average UK house prices. And I bet you can see where it's going next if you look at this chart. It's pretty obvious, isn't it? After the dot-com bubble, crash. After the housing bubble, 2007, 2008, crash. And we are now on what real investment advice calls an everything bubble, because we've got house prices going up, we've got stocks and shares going up, we've got debt going up, we've got leverage going up. So these are some quite significant volumes of money that have gone into different asset classes where the prices are leveraged very, very high compared to the income. And this is another chart that shows you the American housing bubble. And you can see on the left-hand side from 1998 through to 2006, this is the blue line we're looking at. That shows the housing index. And of course, then there was a big crash. So between about 2007 and 2012, prices went down to a more sustainable level. But since then, they've come up again. And since 2012, United States housing prices have been rising much faster than overall inflation and rents and wages, which happened in the last housing bubble as well. So even when people say, oh, we learned our lessons from the last housing bubble, oh, that's never going to happen again. Well, actually, it may happen again, because what we're seeing is exactly the same pattern repeated. But there's a key difference. There's one key economic difference in the last 10 years to the first 10 years between 1998 and 2007. Does anybody know what the key difference is between the two markets? If you get this, you're going to the head teacher's office and you're going to have the day off tomorrow because you've done so well. Fantastic. Does anybody know what the difference was? Because they look just the same, don't they? Really? The same trajectory, everything. Not quite. So I think you're right, Dave, that there weren't quite so many ninja mortgages. Glenn, lovely to have you on. Okay, good point. Is it the difference between bank over leveraging and bad debt versus the natural growth cycle? Could well be. But I'm thinking of something that affects us all every day, particularly if you're an investor. There's one little word that begins with I. Well, it's two words actually. I know, you're trying to guess what's in my brain, and that is a real mishmash of things, and who could ever get in there and work out what's in my head? It's interest rates. Interest rates, yes, absolutely. You see, between 1998 and 2007, interest rates were about 4 to 5%. So after the crash happened in 2007, 2008, in order to get the economy moving again and to be able to borrow money and for it not to be so expensive, what did the banks do? Well, what did the central banks do? They reduced interest rates so that people could afford to pay their debt. Things wouldn't go so badly wrong. There wouldn't be massive crashes. We shored up the banks so that they had capital on their balance sheets again. Everybody thought, fantastic, great. We're out of that one. We'll carry on. But as you can see, that is exactly not what happened. Lending carried on. Banks had to carry on lending in order to produce nominal growth. But at this time, the interest rates were like 1%, 2%. Then they had to bring it down again, and then they tried to push it up again, and then they had to bring it down again. And now interest rates are at 0.1%, the lowest they've ever been. So the one tool that central banks have to control the money supply and look at how they can kickstart the economy, which is usually to lower interest rates, they cannot do that anymore unless we go into negative interest rates. So this is really key. But you might say, yes, but Wendy, we are not the US. We are not them. This is the US. Okay, but let's remember that debt cycles in the UK mirror the USA. We're often right in the shadow of what happens in the USA. And unlike some people who think that the banks are in a much better place now than they were in 2008, the debt has not been repaid. It's just actually increased, but it's been cheaper to service it. So it's been much easier for banks and investors to take on more debt because it's been cheaper to service. Our debt has exponentially increased. And if you look at this chart here on the bottom, I've got it higher on the next slide, you'll see that because the Bank of England wanted us to achieve the inflationary target of 2%, that's their target for inflation, that is the amount of money in the system, they started to print more money and artificially increased the money supply because inflation was actually dropping. And inflation dropping is just as bad as inflation going too high. We've got to keep it on a measured level. So look at this. This chart is absolutely up to date, and this is from, I think this is actually taken from the Bank of England website, or it might be the Office for National Statistics. You can see how much more debt we have borrowed in the last 6 weeks. Huge amounts more debt. The government is in massive amounts of debt. And the only reason that we can service that debt is because it's really cheap to do it. If interest rates went up by even a small amount, it would cause severe difficulty for the Treasury to meet its debt repayments. And here's another chart that shows you this. So this is something called the M4 money supply. I'll talk to you a little bit about that in a moment. But again, this shows you where we were in February 2020. We were about 2.9 trillion. No, that's not quite right, actually. I think that is month on month borrowing. I don't think that's the total amount of borrowing. So you can see there how much more we've gone up by March. Wait till it gets to April and everybody's on the furlough scheme. I think there are 6 million people on the government's 80% furlough scheme. So you can see how debt has exponentially grown. And I think we're due to hit something like, yes, 3.1 trillion in total debt by the time of the end of May, by the time the end of May comes. And some sort of financial commentators are starting to look at this and say just how bad things are going to be, how much money we're going to have borrowed. This is money, have said UK debt will top 2 trillion. It's probably going to be more than that, much more than that, 2.5 trillion is likely, because we have got so much debt already on the books before we even got into borrowing from the COVID financial crisis that we're going through at the moment. So why does, if money printing leads to inflation, why do we do it? Why do governments think it's a good idea, the central banks? Well, imagine this, if we didn't have money flowing through the system, if we didn't have enough money, then we wouldn't have cash flow. And I think we all realise that, you know, there's lots of sectors of the economy that have effectively had to shut down. You know, so think about what you would normally maybe do on the weekend. You might go to a National Trust property and have a cup of tea in the afternoon. You might go out and have a meal in the evening. You might go and watch a film at the local cinema. You might go to the gym on Sunday morning. You might go to the pub at lunchtime and have a drink. You might, you know, get your bike out and go for a cycle on Sunday afternoon. Those activities, many of them are hospitality and leisure. They're all the industries that have shut down, and there's no cash flowing as a result of those industries being locked down and shut down. That puts a massive strangulation on the economy. So to keep the economy going, the government's got to do something. So it's printed a lot of money to enable money to keep flowing so that people get paid, which is what we're seeing through the furlough scheme, to keep businesses afloat, to create more jobs, hopefully, to keep the economy flowing, but also to keep share prices high, because if share prices start to drop, pensions are affected. And we know that older people vote. So it's in the government's interest to keep share prices high as well, which is it's another side angle to keep your eyes on, is what's happening in the stock market. So we know that printing money is inevitable, and the increase in money which has been created, the massive increase, has potentially got an inflationary pressure. Do I think that's what will happen? Well, maybe not. In an earlier webinar, I said definitely I think we're going to have inflation. But actually, I think we will get inflation, but maybe not quite as soon as I originally thought. Now, this is a really interesting chart. So this chart shows the money supply and inflation over the last 20 years. And you can see here that actually there isn't much correlation between the banks printing lots and lots of money and inflation. It's actually stayed at a fairly static level. So that might back up my, the argument of people who say to me, no, this is rich life, you've got this all wrong. And they may be right. I'm not saying I'm always right. Until we see this chart, of course, where we look now at other asset types and the money supply. And really the two that I want you to kind of mostly focus on are house prices and the FTSE All Share Index, which you can see has gone up really in line with the M4 money supply. As those blue charts, the blue columns, as they've increased year on year on year on year, a lot of that money has been used to go into shares, into stocks, into assets, into housing, of course. And this has also driven net public debt higher. So we have asset prices that are higher, we have got debt that is higher, we've got share prices that are higher, and yet the RPI price, the rate of real retail price inflation, has stayed quite moderate. Now, that's partly because we've bought a lot of our goods and services from abroad, from cheap places like China. So the UK economy has been flooded with things from abroad that have been much cheaper to make abroad than they are to make in our own country. And that's kept prices down. The question is, will COVID-19 mean that we now have to start to resource ourselves and we have to start to produce more than we consume? because production is one of the keys to solving some of these problems. But what other results might there be from all this excess money that's in the system? Okay, well, something that happened to Japan was what they called a liquidity trap. So people get the money, so they get the furlough money, or they get the business bounce back loan from the government, and they go, you know, I'm not going to spend it. I'm going to sit on this money, I'm going to keep it in my bank account because prices might go down, and so I'm just not going to do anything with it. Now, the problem with that is all that money is now in the system, but it's in people's bank accounts or in their back pockets, but it's not working, it's not flowing. It might be that the banks say, oh, we're not going to lend any money because we can see that the liquidity in the economy has come right down, and we're worried that people will default on their loans, so they don't lend, so you have a credit crunch. A bubble can be created. I mean, I would argue that we're probably at the end of a bit of a bubble right now. It could be that we get deflation, so it could be that prices actually go down. And I certainly think in terms of house prices, we're likely to see a deflationary pressure on the market. Gentle, because I don't think the government will want a big shock. And I think we'll see individual deals coming up that we can really benefit from. So I think that's really one to keep your eye on, is individual auction prices, auction properties that come up, motivated sellers, deals that will come up, they'll sort of pop up, and somebody who's ready will grab them. But I do think that the government are going to want to keep house prices steady. And as we know, there's still a massive pent-up demand for housing. So although we may be in a bubble, I'm not sure that bubble is going to burst as quickly as some might think it will. The value of the pound might drop. So if you imagine, going back to the dollar, we've got lots and lots of dollars circulating across the world because the US has printed all these dollars. So the value of the dollar has gone down, which means the value of the pound will go down too. Now that itself has other implications. It means that if somebody wants to buy something from us, so let's say somebody from France wants to buy something from us, it's cheaper for them to buy it because the value of the pound has gone down. So that's good because it means anything we make and export, we can increase our export sales. But of course, equally, it means anything we buy goes up because our currency is worth less than theirs is. So that has an impact on us as a country as well. If we have an emphasis on productivity and creation rather than consumption, then this trend can be righted. We can right this trend. But the key is to start manufacturing and being productive. And GDP has not been rising a lot over the last few years. And of course, we've seen today the GDP figures, I think, are down by 2.5% in this quarter. So I'm afraid to say there is some bad news, and it's in the form of pain. The economy is probably going to have a lot of pain moving forward. Now, I don't think you're probably surprised to hear me say that. I think you've listened this far, and I'm sure you're already recognizing that this is going to be a painful time for the economy. So are we going to be like Japan? Now, Japan has suffered something called the 10 lost years. In fact, some might argue it's 20 or 30 lost years. When their market crashed, government raised interest rates to counteract inflation because they printed lots of money, which bailed out banks and businesses, but unfortunately they suffered stagnation, low growth and low inflation. They got into a liquidity trap, and lots of the Japanese were really scared about spending, so they saved a lot of money because they kept thinking everything was going to get worse. And now their debt to GDP is 235%. So in other words, for every person who produces 1 yen's worth of goods, they've got 2.5 yen or 2.35 yen of debt. So that creates this massive drag effect. It's a bit like you having a house and buying it for £100,000, but having a mortgage for £235,000 on that £100,000 property. So servicing that amount of debt is like a big drag effect on the economy. So what does this mean though for HMOs? Get to the point, Wendy. Okay, right. So this is the bit where I think it gets interesting. because I believe that this is where you, if you're investing in HMOs or property, can really benefit. And why do I say that against all this backdrop of terrible pain? Well, we know that people need somewhere to live. Shelter is a basic human need, and we can't get away from that. There's going to be a loss of jobs. There's going to be a loss of stability of income. And that only leads to one thing, a greater rental sector. Some people will need to sell their property. Their properties may get repossessed. They cannot then service the debt on that mortgage. So there's going to be people who will recognise that and want a quick sale. However, banks need to lend money to survive. That is how banks make money, is by lending money. So they're going to have to keep the money ticking over on their balance sheets. HMOs are one of the best forms of hedging against currency devaluation because it's an asset. So you can still keep the rental cash flow coming in, even if the asset does drop in value. It's still a great way to enable you to make money even when the market might be going down. HMOs are great because, of course, you have multiple tenants. And if you're able to work with different tenants in terms of maybe their credit rating, maybe asking for bigger deposits up front, having guarantors, deleveraging some of your risk in working with some of those tenants. Some of those tenants may well become very good long-term tenants because it's going to be tricky for them to move out and into any other kind of property. So I think we're going to see some house prices sinking and some house prices rising eventually. And I do think there's going to be some great deals ahead. So this is where, for you as an investor, if you've got money in the bank now that's not doing anything, get ready, because I think you're going to start to see some opportunities ahead that you could buy and turn into great cash flowing assets in the form of HMOs. And I also think there's going to be some opportunities to use lease options, vendor finance, delayed completion, creative strategies, because there's going to be sellers who will be more motivated to move quickly. And this is going to be an opportunity, if you know how to use those tools, to be able to close on deals quickly so that you can then use your cash for potentially refurbishing or altering that property into an HMO. Okay, I'm going to have a quick check-in at that point. So put your hand up if you can find the hands up button. Put your hands up if you're with me, and put no in the chat panel if you're not. Great. That's fantastic. Okay, that's excellent. Okay, so at this point, can I ask, does anybody have any questions about what I've shared so far? I've got just a little bit to go. But does anybody have any questions or scratching their head thinking, oh, I don't quite follow this, or what does she mean about that? Oh, I'm lost. Anything that you want to put past me. And by the way, I'm no economist. A lot of my learning has been done through reading, listening, piecing bits together. And you might not agree with me, and that's fine as well. Some of this is my opinion. So you don't have to rely on it, but it's just what I'm noticing and what I've seen in my years of being an investor. These patterns tend to occur. Right, Ingrid, that's a really good question. I was discussing that today with my mentoring group. Can we use the bounce back loan to buy houses? Well, do you know what? It's not entirely clear. I did speak to my mortgage broker about this, and he said, oh, it's a definite no-no. Lenders will not like it if you use the bounce back loan to buy houses. In actual fact, the business banking, the British Business Bank has not made it totally clear whether you can or whether you can't. What it says is that you need to use it as working capital. Now, what does that really mean? If you're going to use it as working capital, for some people that will mean they're going to use it to invest in their business in terms of creating more opportunities for trading. So, for example, if you're running, let's say you're running a takeaway, you might get the business bounce back loan, and that might enable you to do more marketing and sales of your takeaway business. Or let's say if you're running a furniture shop, it might allow you to take on another member of staff who can, head up sales on a Sunday when maybe you don't have anybody to cover the shop. So working capital for some businesses will be really clear cut what that means. But as property investors, What we do in our business is we invest in property. Any capital we have goes into an asset. Now, I think over time this will become clearer, so watch this space. I'm going to keep looking at this myself to see whether it is or is not deemed to be possible. But the rules do not make it clear at this point in time whether we can or whether we can't. I haven't spoken to any lenders about it yet, which I will do to see what their reaction is about it. If we can, happy days. If we can't, there are probably other things you can do with the money, which I'm going to come on to a little bit later on, that you could still use it in a wise way and maybe in a year's time liquidate an asset and then pay the money back to the government, and maybe you've made some money in the year. So if you're clever with it, I think there are things you can do quite legally and above board. As to whether you can actually use it for buying houses, that is not clear at this point in time. So I wouldn't say that it's a definite yes. Okay, so thank you for those. This I thought was a really good quote from Ludwig von Mises. He was Austrian, as we can see. But this is what he said. He was he was from the Austrian school of economics. And he said there is no means of avoiding the final collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as the result of a voluntary abandonment of further credit expansion, or later as a final and total catastrophe the currency system involved. In other words, it's likely to collapse. And here are some other sources of information which I will send out to you with the email from this webinar, so you can look at this up yourself. A really good book to read is one called The Road to Ruin by Jim Rickards, and he has got a YouTube channel as well, and speaks a lot about how the economy has grown and how we've over leveraged, etc., and what the likely outcomes might be. Okay, but what about, let's go back to HMOs then for a moment. What are the fundamentals of HMOs? Well, we all know that HMOs provide low cost, easily accessible housing. And in the economy into which we're about to step, I think that is going to be in more demand than ever. We offer all-inclusive rents and bills, because that makes it affordable for people. It means they can budget. It means that they are much more likely to want to contract with us, to buy that kind of opportunity, because it's easy for them to move in and live there. We can offer flexibility in our tenant credit status. So it might be that we decide that we'll take some tenants who have got less good credit ratings, but we might want some, risk or some other kind of guarantor to be able to call on should they be unable to pay the rent. That's your choice as a landlord. You don't have to do it, but it's a great opportunity to do that. You might decide to work with the local council. I've heard some great stories of people not only renting rooms out to individuals that the local council has sent to them, but renting their whole house on an FRI lease to a local council. So I think some of those opportunities are going to crop up as well. Talked about multiple streams. You might be able to give some flexible agreements. So not just 6-month ASTs, but maybe decide to do 3-month ASTs. See how the tenant gets on, see whether you think it's a good fit, whether to keep them as a tenant or not. And it also looks like in terms of the eviction clause, which was issued by the government in March, that is going to be lifted in June. So by the end of June, we should then be able to go back down to the 2-month notice period for evicting tenants on Section 8 and Section 21. Your HMO is leverageable. So while debt is very, very cheap at the moment, it makes sense to leverage because you can easily service the debt on just 2 or 3 rooms rental. So this is a really good time to leverage. Be cautious in the sense that you always want to make sure you can service the debt. So don't get into a position like we are probably going to get into the UK government, where the debt is so high, if interest rates go up, we're going to collapse. Don't let that happen to you. But an HMO can be used in various tenant markets as well. There's a flexibility there. And even if the currency is devalued, bricks and mortar is always going to be a fixed asset. It's very likely that as that funding, that money does come into the UK economy, if the value of the pound goes down, which again is probably likely to happen, what will happen is the value of assets will go up because inflation will push the price of assets up. That's always what happens eventually. So this is a chart that shows the link between UK prices and the money supply over the last, I suppose, just over 100 years. So if we follow that line, and we've seen charts today that show how much extra money is in the economy now, there's only one way for house prices to go. So it's short-term pain. I think as investors, the key is to keep tenants coming in, to keep our cash flow good. Check your cash flow forecast every week or every fortnight to make sure that you are still in a good liquid position. But, you know, I think in the long run, we're all going to thank our lucky stars that we invested in HMOs. So here's a few other practical suggestions. Keep an eye on the US economy. You know, if you're interested in this, and if you're thinking, yeah, actually, you know, Wendy's highlighted some good things for me to learn about tonight. Keep an eye on the US economy. Look at the debt to GDP ratio of the US and the UK, that debt to income ratio, or really GDP is more like turnover. Watch unemployment figures. They're massive at the moment, aren't they? We've got huge amounts of unemployment, and we're going to have more at the end of the furlough scheme. But it may well taper. It might not be too dramatic. House prices, it's a bit unpredictable, very difficult to get a real grip on this because of the demand for housing, and yet because of the leverage of debt that we've got. So I think it's up to all of us to move fast when we see those opportunities. Keep an eye on the minimum wage, what the government decides to do about that. Lending criteria, which I'm going to come on to in a moment via Bruce's slides. And this is a great opportunity to use other people's money. Think about it. If you've got a friend who's got £50,000 sitting in the bank, they were getting 1% per annum a few months ago, and they're now getting 0.1% per annum. Could you offer them 5% if they lent that money to you? Could you offer them 7% if they lent that money to you? And then what could you do with that money? If you could see some bargains, if you know what to look for, if you've got your deal analysis sorted out, this could be a great win-win. And there is nothing illegal or immoral about it, as long as you do it properly with FCA guidelines. And this is a great way to help other people to make money as well. So I'm really excited. I think you can tell, I think this is going to be a great opportunity for us as investors if we get ourselves in the right place and in the right position and in the right mindset to see this as an opportunity. Now, what about the banks though? Okay, so let's come on to the banks. Well, we've got a central bank, the Bank of England, and they work hand in hand with the government. They have to in a time like now. And when we look at how much debt has been created by the government, this is directly related to the fact that the gilt has been produced by the government and bought by the Bank of England, the central bank, in order to print that money that the government needs. So that's the central banking system. But of course, we've also got high street banks. So as we know, a few weeks ago, Rishi Sunak announced the fact that high street banks were going to shoulder the coronavirus business interruption loan scheme loans. But of course, that lending took absolutely ages to get out into the market. Now, as of last week, about £1 billion has been lent under that scheme. So it's obviously getting going. We did apply for one of those loans, and we still haven't heard from our business banking manager. So that just goes to show how slow it was. And this is, of course, because the banks were having to shoulder the risk. So they were going through all the usual checks and balances on people's risk to be able to assess whether that was something that they wanted to lend or not, whether they wanted to lend to those particular businesses. But then the bounce back loans were announced by the government, where the government were backing them, and lots and lots and lots of money has now gone out of the coffers of the banks because they've all been backed by the government, and it's been much easier to borrow them. So what do we see? What's happening here? Well, what we're seeing is that as time goes on, the banks are going to become agencies for channeling state aid. The banks are not going to be necessarily using their own balance sheets. They'll be using central government finance that comes through the Bank of England, and they will be channeling that to customers and to individuals. So they have to become partners in dealing with non-paying debtors. And this is going to be a fear and a worry for banks. And I've been looking at some of the research into what the banking industry are doing right now. And some of them do have some fears about what happens if people don't repay those loans in the next 2 or 3 years, how much they will be backed by the government. So I think the banks have got concerns about liquidity and stability. And of course, this is going to impact on their lending, because they are not going to want to lend out onto the mortgage market if they are unclear or unsure people have got good credit ratings. So let me move on now to Bruce Mannering's slide. So this guy Bruce, who I know is a mortgage advisor, very kindly offered to give me some up-to-date information. In fact, this was 2 days ago, about what's happening in finance markets, particularly for HMOs and for finance and for mortgages. So I'll just share this with you. This might be very relevant if you are currently going through a purchase. So you probably remember a few weeks ago, the Royal Institute of Chartered Surveyors said its members should not enter occupied properties. So that meant that basically all the surveyors cancelled all valuations. So effectively the mortgage market was paralysed because nobody could go in and do any valuations. And a company called Together Money funds most of the alternative bridging money on a wholesale basis. And that kind of almost shut down. And some of the small bridges, like small bridging finances like Roma, also lost that cash flow of money. So they too have suffered from that kind of domino effect of the doors being closed. Now, if you know how HMOs are valued, which is they're based on usually on a commercial valuation, or it might be a hybrid of bricks and mortar and commercial, they require a survey in order to have a value added to them, or a value attached to them. There is another model that is used for the general buy-to-let mortgage or the general residential mortgage market, and it's called the AVM, the Automated Valuations Model. And this is a model which has been around for a number of years, and originally was used to check valuations. So if you haven't heard of AVMs, it's because it's kind of like an industry insider tool that people use. But these have been used in the background as a kind of check and balance. But now they're being used as an alternative to traditional inspections. So what does that mean? Well, that means that general buy-to-let mortgages are still taking place, and their valuers are able to do desktop valuations. So when there's quite a lot of data in the mortgage market, let's say for a 2-bed terraced house or something, the AVM is able to produce a price and a valuation for that particular property, which the lender will then use on which to make an offer. But they can't be used for new builds or newly refurbed properties like HMOs. So that, of course, has then really stifled the HMO lending market. So for buy-to-lets, Paragon and the Mortgage Works are using AVMs, and they are still lending up to 75%. So that's really good news. There are lenders out there who are lending on a buy-to-let still, and they haven't particularly slowed down, and they're using the online model to be able to value. Precise and Kent Reliance are currently lending 70% loan to value. Now, Bruce told me that this might change this very week, but that's where they're lending at the moment. So if you're looking at getting a mortgage of Precise or Kent Reliance, you can expect a 70% loan to value offer. Residential mortgages, Halifax and Nationwide are still lending, which is great. But it looks like more and more lenders are going to start to adopt the AVM model rather than wait for RICS, which is the Chartered Surveyor body, to give the go-ahead for inspections to resume. Now, actually, as of today, of course, we've heard that the estate agency market is now opening up, and it's now possible to do viewings, and it's now possible for surveys to go out. So, as I say, this is hot off the press 2 days ago. It's already out of date. So AVMs are something, though, that we probably need to all become more used to, because I think if you are also buying single buy-to-lets, this is going to be more of a standard way of valuing a property. What about after lockdown? What did Bruce say is going to happen after lockdown? Well, he thinks there's going to be a backlog of properties requiring site visits. So there's probably going to be quite a lot of delays to mortgages. So if you're going through a refinance right now and you haven't already had a survey, you're probably on a waiting list. So it's just going to take a bit of time, and you have to keep prodding your mortgage broker to find out what's happening. If there's any paperwork that you still need to submit, get that in, because it's the sooner you get any paperwork in, the better. That will speed up your application. Bruce has said that they're expecting a dip in property prices of up to about 10%. So he might be right, he might not be right, but that's maybe something to consider if you are going to start doing some viewings and thinking about prices. This is a good time to be able to go and negotiate with a vendor, because it's going to be a buyer's market out there. So he's suggested you get your paperwork in and take advantage of pre-lockdown house prices, although I actually think it's going to be post-lockdown house prices that will be even better. Another point, which I think is really good from Bruce, is who the tenant is really matters. So if you have got a tenant who is classed as a key worker, that's a big plus, because you're giving the lender confidence the tenant will be in work and therefore is most likely to continue to pay their rent. So demonstrating that you've got a sound and solid business, that you can attend to cash flow, that you've got your business plan, cash flow forecast, profit and loss, all those key pieces of documentation that are needed to demonstrate that you are a good property investor, I think that's going to become more and more important. I think over the last few years, we've seen more of a kind of professionalism in the HMO property market, and people who were running their HMOs without licenses or building regs, a lot of them have been found out with some of the later regulations that come in. So if you've done it properly, if you followed our 5-step system, you've done any of my training, we've got some mentees on the line, people who've done the mentoring course, you will be ahead of the curve, because you'll know exactly how to implement this stuff to make it worthwhile and to make it a long-term business proposition that banks love to lend money to. Now, if you're interested in speaking to Bruce, those are his details. I promised that I would let you have his details, and I will put them on the sheet that I'll send out after the webinar with all the further information on as well. So if you've got a property you're looking to finance, or you've got some queries about a mortgage, or you just want to speak to a different mortgage broker, then Bruce is a great guy who knows a lot about the mortgage market, is very, very experienced, and he works with a lot of commercial lenders. Okay, so finally, what else can you do at this time? Okay, well, a few other ideas. They're a little bit off the wall, but hey, I'm going to tell you the truth here. I'm going to tell you the truth, what I'm doing. So have you thought about investing in other assets such as gold and silver? That's maybe an idea. Certainly Jim Rickards, in his book, The Road to Ruin, really emphasizes the importance of precious metals as a way of hedging against currency fluctuation. So there you go, that's an idea. Recognize that housing is essential. So whatever value it has, whether you buy it now and you might lose £10,000 over the next year, as long as you're not buying to flip or you're not buying to sell quickly, housing over time goes up in value. And I believe that's what's going to happen again. Liquidity is the key during this time, making sure that your tenants are paying their rent. Have you got good systems for collecting that rent? Have you got good systems for making sure that you are looking at rent income every week or every fortnight or every month, so that tenants who get behind, you can work with them. You can collect arrears. You can set up an arrears payment. Ensure that any of the debt that you have, you can service. So this is a good time to pay off bad debt. Because interest rates are very, very low as well, it should be much quicker for you to pay off debt that is kind of a bit like a noose around your neck. If you've got bad debt, pay it off. Or expensive debt, pay that off as well. Incur good debt, so debt that is secured against assets such as HMOs. So Sarah, it won't matter if you refinance for an HMO and get your money out of the deal. That's a great thing to be able to do. You can get all your money out of the deal. It's going to be very interesting to see what happens, because yes, you're absolutely right. If you do a deal and in another year your property is worth slightly less than what you bought it for, or they don't count the added value enough for you to get all your money out, then you'll have to consider a different plan, a plan B. However, what I would say is there's going to be a lot of investors around who would probably be willing to lend you some money, what I call backstop lending, to overcome that shortfall, and you could pay them maybe 3% per annum. So because interest rates are very, very low, borrowing money shouldn't be too much of a worry when you do it against an asset. But always make sure you keep yourself liquid and service that debt. If you've got money that's sitting in low interest accounts, move that into other asset classes. Look at how you can lend that money. What can you do to keep your money making you money? If you've got money in different bank accounts, don't have too much cash in any one bank. Not a good idea to have all your money in one bank. You might want to split it up. But equally, you might decide you want to put it into a different asset class as well to make you a bit of money over the short term. Okay, so we are holding another webinar next week. We've kind of got a webinar series going on here, and we're going to be speaking especially, and Ian's going to be on that webinar next week, how can you invest in HMOs right now? So that's next Wednesday at 7:30 p.m. You want to register for that webinar, because in that webinar, Ian and I are going to be sharing with you our trade secrets to making money from HMOs, both during coronavirus and afterwards. So how can you find and source those opportunities? How can you manage a builder and a refurb with social distancing? How can you manage tenants and the cash flow if you are worried about liquidity and servicing your debt? What are the tools that you can use, and what are the systems and processes you need to put into place? So we're going to share with you exactly how we've been doing it, how we've continued to make money over the time the coronavirus has been here. And if you thought the doors are closed on HMOs, think again, because there's plenty of people getting great deals and great opportunities. That is the link, and you probably can't copy that right there. So I'll put that on the sheet that will go alongside the notes for this webinar. So if you want to register, those webinars get booked up very, very quickly, and we know we'll have a lot of people on there. So make sure that you register your place so that you're not disappointed in next week's webinar on how to invest in HMOs right now.